the stupid Zoom has so many pop-ups, you can't. Okay, sorry about that. All right, so I think we're on, let's see here. I think we do problem 3, we did problem 3. So we're on problem 4. All right. Oh, I know, it just hit me my, oh, I'm gonna copy that. Okay, all right, so let's take a look here. So we have. We paid 54,000. And the question is, what did we get for it? Well, our assets at fair value are that. Our liabilities at fair value are that. So the question is, what did we get? At least identifiable assets, I should say. I don't like that term, but anyway. Okay, so the identifiable assets are this. The price we paid that. So the goodwill or the unidentified will be the remainder of it. It's kind of, I mean, I don't know what to call it, but I think it just bothers me that they say it's unidentified and then they call it goodwill. Well, then it's a different, but regardless. So identifiable assets, I should say net identifiable assets, better way to put it. More accurate. 48,000, we paid 54, so we must have 6,000 in goodwill. All right, I think we can start filling this thing in now. Okay. Okay, additional paid in capital. And so this investment, this is the problem. And it's a problem because this investment is basically this entire company. So Bill Company is this 53. So we have to take this out the books because we'd be counting Bill twice. All right, so, oh, wait a minute. Okay, we got to put assets in the books, land and building, 2,400, 4,800. 2448. Land building. And I'm missing one. What is it? What asset? What asset am I missing? Goodwill. Yep, goodwill. So goodwill will also have to be in here. The 6,000? Yeah.
Professor, how did you get the 6,000?
Good question. So these are the net identified by, so here's the assets at fair value. Here's the liabilities at fair value. And so this will be the net identifiable assets at fair value. I should say put that in there. But now we paid, all the way up here, we paid 54,000 for it. So these are the net assets. You know, this is what we got. The way we could identify these. And so our net identifiable assets are fair value of 40,000, but we paid 54,000, so we must have paid extra for something. And that's when it comes down here to this goodwill.
I see, thank you.
Yeah. It's kind of weird terminology. I can't remember back in my day, I can't remember what we called it, but I don't think we called it identifiable assets. But regardless, I mean, it's I guess you have to call it something. Yeah. Okay. So let's take a look here. I haven't been doing my color coordinating like I should be. It's the most important thing. Okay, so here's the assets. Oh, I didn't, oh, hold on, I still got work to do here. So this is. Okay, so far we got the S and the A. And now we need the D for dividends. And dividends are the wacky ones because they are they get added back into, because we subtracted them from our investment, they get added back into our investment. Remember back in the day, we would go through that equity investment and take out the dividends from the investment. Well, so we took out the 1,200. Well, if we're trying to get rid of this account, we're kind of unmixing the cake. We got to put it back in. Okay, so Sadie, the next thing we have to do is take out our investment. And last, not least, is additional depreciation or amortization. And well, the land doesn't depreciate, but the buildings will, so 4,800. Hey, what happened? So 4,800 divided by 10 years, what, 480? All right, so coming down here, so depreciation expense. And depreciation expense has to increase by 480. And we have to decrease our asset by that because we are depreciating it. Now, our income is already this 4560. If you're wondering, well, hold on a second, why do this for you? Is because of the difference between those two. And I think if you take the 5040 minus the 480, you should come up with this number. Let's give it a shot, see if it works. It should. Yeah. So that's what we did. We did our calculation, you know, they told us their income was 5,040. And then we subtracted out the additional 480, and that's how we came up with this number. So that's why this is the income that we take out down here. Okay, I think we're ready to start smushing them together. That one's 0. Now, hopefully. Uh-oh. No, that's right. These two should come out to be the same. And they are. Now, basically, on the statement of retained earnings, the only thing that's going to be left is the stuff on the parent company on Amy's books. Amy's books going to be the only thing that's left. The beginning retained earnings were taken out, the income was taken off, the dividends were taken off. So this is all gone. But you're gonna be left with the parent companies. The income is the same. It's the same income as up here. Minus the dividends. So it should come out to. Yep.
Why does net income not change with the bill with adding both Amy's and Bill's company income?
That's a good question. It's because so you're putting everything on the books at the same, you know, basically you're taking the revenues, adding them together. Cost of goods sold, adding them together. the expenses, you're bumping them up to what you had on yours. So basically everything, if you really look at it, these two, we insert. I don't know who made the default light blue that can't be seen. I'm sure there's a way to make the default. I'll have to look and see what it is. But it's like, yeah, we'll make that line, we'll make it invisible. So if you think about it, the income from the this is 5,040. It's already included in there. We've taken off the 480. But this 4560 is exactly the same income. It's just that we subtracted out the additional amount for excess assets. So when we remove it, all we're going to be left with is basically those two companies together, with the inclusion, though, of this additional asset, or excuse me, expense here. This additional 480 will be included. So it'll be 3,600 plus that. But yeah, so if you own 100% of the company, it should come out to be exactly the same. And the reason for that is that the equity method is basically doing exactly what we're doing on the screen here. And that's why they use it for the most part. But yeah, it is so everything, if and by the way, if you were to say, okay, well, what would this be? If you didn't have this equity income, this would be lower by whatever, 14,000 something. So this 4560, this income from the bill is included in that 18,960. It just has 480 taken out of it. Yeah. And two, and remember that the there are no shareholders or anything out there in the market. The only people that know about Bill Company, the only people that have any interest in it, is the Amy Company. This company does not exist out to the public, or to shareholders, even private shareholders. Okay, so now we're going to take the assets and smush them together. That's a technical term, by the way, smushing them together. When you have your job interviews, tell them that you know how to smush assets together. Very important. All right, let's see here. I'm going to copy this. All right, now the one that's always nerve-wracking is making sure that this investment account comes out to zero. So you take the 57,360 plus the dividends. We subtracted them to get down to the 57,360. So now we're going to add them back in and then subtract out all the rest of this stuff. And that should come out to zero. And again, you want to go out to zero because you'll notice that all the stuff from Bill is included over here now. This is Bill, this is our Amy's assets and Bill's assets together. So we're taking Bill off the books, the Bill investment, because we have all Bill's stuff. So those are the total assets, and hopefully. Looks too much like the other one. There we go. All right, so these are the total assets for the consolidation. And hopefully down here will be the same thing. Now, the first two, we take those and smash them together. And all the rest of this stuff is going to be only the parent company. The only shareholders that are out there are for the parent company. They're on the capital. Retained earnings are here. Yeah, that is. Too light. Excuse me. And so here's what happens. Amy Company makes their financial statements, just the ones you see here. Bill Company makes theirs. But when they're consolidated, it'll just look like that. I mean, it probably won't have zeros in there, so. But those will be, that'll be the consolidated financial statements. The income won't change. The parent company's shareholder equity won't change. It'll all be exactly the same. The only difference is that we're now picking up the all these accounts from Bill Company. These consolidating entries are on the books until you run the financial statements. They're consolidated and then they're reversed back out, and everybody goes back to keeping their own books separate. They'll Amy will have their own books, and Bill will have their own books, and keep operating them separately. And a lot of times companies will keep them separate for a number of reasons. Sometimes, a lot of times they'll buy them for the name. You buy a company and you keep the name of the company. Websites and stuff, like YouTube and all that. They buy them out and then they keep the name for them and keep it as a separate entity for a number of reasons. It could be that in the future maybe you want to sell it off. Sell it as a complete entity. Sometimes, and this is especially true for some of the tech companies. If IBM buys a little tech company, IBM has 50 layers of management and all this kind of stuff, and it's not going to be very they know what they're doing, but they're not generally dynamic. So a lot of times they don't want to enforce their here's what you wear to work and all that kind of stuff on these startup companies. And so they'll let them kind of figure it out on their own and go on and grow kind of naturally, rather than having that direct takeover whatever of it. So there's a number of reasons why they keep them separate. It's also good to have your eggs in different baskets and all that kind of stuff. Okay. Question on this one? We will do one more and then we'll do the book problems. I'll tell you what, I'll be quiet here. See if you can figure out the goodwill on this one. Actually, I better check and make sure there is goodwill. There is goodwill.
Is it 750?
Yes, it is. Yep.
Okay.
Yeah, and these are done at the fair values, and you'll notice it doesn't always work out like this because the company's been open for a year, but I think I keep them this way. Let me check and make sure I'm not lying to you. Like land, the 2100. And you notice it down here, I kept that, and it doesn't always work out like that, but I kept the land at 1800. So you go, oh, well, how did, it's 1800. Yeah, the fair value is 2100, so that's where we got that excess. Because because this is generally a beginning of the year and this is ending of the year, they don't always work out that way. But I artificially kept it that way so that it looked the same. And so basically you go, okay, well, how much in identifiable assets do we get? And then we have liabilities we got to pay off. So what are those? Oops. I just say net identifiable assets. All right, so this is what we got as far as we can identify. And we paid in the future I should put this down here, or I should I don't know why I put it so far apart. But cash price paid, so this is let's make it make it yellow. So the question is, those not identifiable assets is what we paid, so we have unidentified assets, which we call goodwill. And so state the it's 750. All right. Well, I think we're ready to start chunking away at these. Hey, no, we're not. We don't have the handy dandy Sadie thing. Copy that over. Yeah, you don't have to copy that over. I'm just. Okay. First thing I do is take out the stack. Oops. Just fun watching you learn how to use a computer. I actually got the case off my computer. Got to put a different power supply in it. Yeah. When COVID hit a couple years ago, the computers I had were not really meant for online meetings. So my kid had two old gaming computers, so those are what we. So that's what I got. So it's kind of loud, but it's old. They're not. They're fast enough to do like this stuff, but. It's just kind of funny. And two, back then you couldn't buy computers. Everyone was snatching up all the computers, so you couldn't buy them. It was like, oh, good, okay, we got these old gaming computers. Oh, they should be fine. I think it's got 4 hard drives, four solid state hard drives in it. It's really old. It's that fast. All right. So investment account. Oh no, we want that. We want assets. All right. Our assets are 300 to 600. And the one that I always forget is goodwill, which is 750. It doesn't balance and I get really mad, and then when I figure out that it's goodwill, then I get even madder and go to therapy. All right. 1650, I think. Dividends are easier ones, but they're also kind of one of the wacky ones in that we actually add those back in. Because we subtracted it out earlier. Using the equity method. Income. We're taking it out because we're taking it out of here because we are actually going to count all their other stuff in here along with it. Okay. Let's see. I don't think I did the expenses yet. I did not. Okay, land isn't going to depreciate, but the buildings will. So this will be 60. All right, so. And this one, the weird thing about the expense one is that it's the only one that doesn't go through the investment account. It comes down here. To be taken out of the asset. And you'll notice why though, because you say, well, why don't we take it out of the investment account? Like, that we actually already have. Because their income was 630, we took out the 60, so this 570 actually already has that taken out. So the investment account actually already has the 60 taken out of it. We have to reduce our assets by 60 because of the extra year, and we'll keep doing that for the next 10 years. Okay. I think we're ready, right? Or chunking them together. Hopefully they like. And if we did it right, we should get 2370. Hey. And you'll notice that this is all, oops. This is all included in this 570. So this is coming out. And then we're going to add them all up. So taking all the revenues for both companies and so on and so forth. Okay, the only thing left over here is parent company. Income from above. I put it as negative for the dividends. If you don't put it in negative, that's fine, as long as you subtract it out. And those two should equal, and they do. Yeah, all right, investment account. Add the dividends, subtract everything else. And we want it to go down to 0, and if it does, we're very happy. Because everything that's included in here is already added in over here and for goodwill too, down here at the bottom. Okay, and we have our liabilities. Ooh, hold on. I'm showing you how to do it incorrectly. Plus their liabilities. So the total liabilities here. Only the parent company's common stock is still there. And the retained earnings. Same as up there, and hopefully. Yep. And if you're wondering, like, can you check, can you check the number for the total assets over here? Because you'll notice it's different because obviously we've taken both companies and kind of smushing them together. How can you check that number? Actually, you can. If you take, you'll notice that down here, these two sides have to equal. Well, the only thing that gets added in for the liability and equity side are these liabilities. So I can copy one of these. So if you take $23.70 plus those two, it should come out to that. Let's go a little bit different. Orange. Because these two numbers are the same, right? And the only thing that gets added into these on the liability and equity side are the liabilities. These are all gone. So if you take the total assets and then add in the accounts, it should come out to be the same. And so if you come up with a mismatched number here, let's say you came up with 25,770 and this was 28, something, whatever. Well, then you can look and see which one, you can check to see if the total assets are correct. Because it should be this plus those two, the liabilities from the subsidiary. Question on that? All right, let's take a break. I think we come back, we'll start in on the textbook problems. Yeah. No, do you want me to put this one back up? I don't know if Evan has this one. I'll put it back up. And we'll say be back at 6:48, 6:49. Let's see 7. You barely see it. All right. all. So I think what we're going to do is these two problems and then we'll. I'm gonna sneak over here and grab my. Okay. So I think we all know kind of how to make the journal entries now. And now it's kind of trying to get the numbers. So seeing them given in different formats. And one thing that the CPA exam is kind of notorious for doing is giving it to you in a bunch of different formats. They'll give you some information directly, some indirectly, and so on and so forth. Okay. So problem 328. Is that right? Yeah. All right, 100% of their stock. This is the price that they paid. This is the carry amount of the assets. Okay. And we have some differences in reported values. All right, so for trademarks, the excess is 100,000. Customer relationships. They didn't have it on their books, but we bought them. A lot of times these are customer lists. For instance, if you buy out a CPA firm, what you're basically buying out are the lists of their customers. Those are the customers that you're going to pick up when so a lot of times customer lists are actually, what you're buying. For a lot of us, the actual tangible assets like the computers and that are, a few $100s or a couple $1,000s or something. But you're actually buying the list. Same thing with things like landscaping and stuff like that. The lawnmowers, you might have a few thousand in those, but the real value is in the lists of customers. Okay, now what's unusual about the equipment?
It's went down in fair value.
Yep. The equipment is actually overstated by 30,000. So we're going to have to deal a little bit with that when it comes to the assets and with the expenses, because we're going to be depreciating less than they are. All right. Now, I happen to know that there is some goodwill on this one. All right, so these are the identifiable assets excess is this. So the question is, how much is the goodwill? And they don't give you all the information, at least not at the top here, but how much is the goodwill?
55K.
Yes. Excellent. Yeah, you'll notice that the total amount that we paid over the book value was 200,000. Oops, wait a minute. So this is the amount that we paid over the book value was was 200,000. Now, we identified 145 of it. So we're going to subtract that. And that will equal our unidentified. Oops, hold on. Okay, so this will equal our unidentified assets or goodwill. All right, and I think with that, we can probably start. We can actually go ahead and do the expenses, I guess. Trademarks have infinite life, so we're not gonna worry about that one. Customer relationships, 5 years. So maybe I've got to divide by 5 is what? 15,000. Hey, how come that's not correctly formatted? And this one's kind of weird, though. This would be divided by 10 years. And what's going to be weird about that one?
Going to be credit depreciation.
Yep. Exactly right. Yeah, this one is kind of weird because it's going to reduce our expenses because we're going to have reduced equipment. So we're not going to depreciate as much. Okay. Okay. All right, well, let's start filling these in. Okay,
Professor, say it one more time. It's gonna reduce, that $3,000 is gonna reduce the depreciation. Is that what you said?
yes.
Okay.
Reduce the depreciation and and it's gonna be kind of strange because we're gonna actually add it back in
Okay,
to the assets.
thanks.
And it's one of those things, there's always something weird that happens with it, you kind of get into stuff like this. I mean, in real life too, you know, it is not just for the book problems, it's. Okay, so let's see, we have, okay, they don't have any additional paid in capital. There are many states that don't require par value. And here's the investment in O'Brien. Okay, so let's see, we have S. By the way, that 350 looks familiar. That's this. The book value or carry amount of the net assets would be whatever's in the equity section. Okay. So now for the one that's usually not tricky, but then in this case it will be tricky, is the assets. Okay, so trademark. $100,000. Customer list. I think it was 75, wasn't it? Better check. Yep. And equipment is the wacky one. I said earlier, this is going to be a credit. We're going to reduce the amount of equipment. Oh, and we have one more. What is it?
Goodwill.
Yep, goodwill. Okay, so we come over here. So we're going to add these and then subtract the 30. Okay, so that takes care of our initial purchase anyways, and now we gotta do the SADIE, DIE. All right, so dividends. We gotta take out the income. All right, now for the wacky ones. All right, up here, so customer relationships. Basically. What's it doing that for? Who cares? All right, customer relationships. Oh, I get it. So this would be amortization expense. All right, so down here. Wrong color. All right, so I'm gonna separate, you could lump them together if you wanted. I'm gonna separate them out, though. This would be, I'm gonna put this as E here, the amortization expense. We'll be increasing the amortization expense. And for this one, what is it, 3,000? It will be decreasing. Let me think about this, make sure I get it right. So 30,000 decrease, so eventually that 30,000 difference will go away over 10 years. It's gonna reduce our expenses by 3,000 every year. This is gonna increase our expenses for the next 5 years. Yeah, that's it. All right, well, let's start consolidating these. Oops. Right? Yes, right. Okay. And this is 935, like we want it to. All right, let's go to. All right, the stock for the subsidiary is gone, so only the first one is left over. Take the income above, subtract out the dividends declared. All right, and let's see if this investment account works. Yep. Before we do our liabilities, let's check and see if we are. See if the 28, 2,800,000 is right. If we take this plus these two. Wait a minute, not this one, this kind of stuff, what are we doing? Actually, just plus this one. So 2,664, the only thing we're adding down here is the 136,000, so those two together should equal that, and I think they do. Because you'll notice down here, the only thing we add on to these three. I should say four. The only thing we add onto it is the 136. And notice that these two equal. So if we add the 136 onto this one, it should come on. Now it's going to be all jumbled up in this stuff, but in total, it should be the same. Question, I think? All right, let's do this one. We may get out of here early. Yay. Okay, this one is unusual. Because. Well, we have a patent that's undervalued. That's not that unusual. So here's how much they paid for it. Here was the book value. And we have a patent that was undervalued for 204. All right, now. So this is the fair value of the identified assets. Is odd about that.
They paid less than it was worth.
It was a bargain purchase.
Mhm.
So this is, so this would be a bargain purchase. I should say gain. Of how much? Oops. Gain is. 126.
26, yeah.
And you'll notice something when you look at the income statement for Brooks. It's on there. That's how they came up with it. Now, this is gonna be a one-time deal. The year they bought it, they're gonna recognize that gain is, they're never gonna do that again. But for that first year, they're gonna have that gain on the bargain purchase of 126. So there is no goodwill. We don't need to do those calculations. But yeah, okay. This one's all set up for us. We may as well do the patent technology. So this would be like an amortization expense. I'll say expenses. That far over there. So 204 divided by 6 is some number. 34,000. All right, well, we'll use that. We'll get that when we come to it. Okay. So we're going to start chunking away at it, I guess. All right. You notice that 1015 looks familiar. Scratch that 1,105,000. What I said doesn't look familiar, but the 1,105,000 does look familiar. Let's see here. Assets. So we have this patent technology. There is no goodwill, so. Dividends. My D is underlined there for some reason. Income, that's what this is. Excuse me. There's too many things called equity. You know, equity and earnings. Equity method, equity investments. All right. E. Expenses are 34. They lump the depreciation amortization. You'll see a lot of companies will do that. Lump them together. And that's going to come out of this down here. And you'll notice that this income, the subsidiary had 233,000. You subtract out that 34, you're gonna come up with a 199. So that's how they got that. So this 199, if you're wondering, it already is taken out of the income when we look at the investment account. All right, guys, push them together. Now, remember this bargain purchase. I'm gonna do this one first. This one is a plus. Well, excuse me. Hey. Oh, I multiplied them. Oopsie daisy. This would be. Now, again, make sure you have this in there as a plus. The 126. Or else these two aren't going to match. I'm not sure why that would be put underneath cost of goods sold. Usually you'd see that under after the depreciation amortization. These are operating expenses. This would be other revenues and expenses. This would usually, I believe, go below the depreciation. Probably doesn't matter too much. Okay. Only thing left here is the parent. Income. Dividends. And. And hopefully this will come up. Yep. $3,033,000. 3,033,000 plus 106 would be 3,139,000. That's it. Only stock that's left is parent company. Retained earnings is from there. That should be the same. You could also look at it like that. Yeah. This plus that is that. And so this would be what their that's what their consolidated financial statements would look like. I mean, they wouldn't have the zeros in here or anything, but the rest of it, I mean, the dollar amounts would be the same. So each of these businesses would have their own financial statements, they have their own accounting people and all that doing them. And then they'll take them and smush them together. We call that smushing. Sometimes they call it consolidating, but we call it smushing. And those are only on the books for until they make the financial statements, and then they're reversed back out, and everybody goes back onto their only worrying about their own company financial statements. And if you look at large companies that have consolidated financial statements, and most large companies do, they will put out, you know, their own. Like if you look at Ford, Ford will put out their own. Okay, here's us, here's Ford, and then they'll say, okay, here's the consolidated that have all their subsidiaries added in. Question? Okay, so there are. Hold on, I need to check something here. Make sure that I have it to drop for those. Okay, so the chapter 3 handout, you can put that in, and actually the problems you can put in too. All right. Any questions? Be quiet, you guys are probably sleeping. Okay.
All good from my end.
All right. I'm sorry, does you need to see it? Does anyone else need, does anyone need to see the, there's, if you want to get a screenshot of it, here, I'll back it out a little bit. All right.
So basically, all those problems we did are due next Friday, correct? We want us to upload on the,
Yeah, everything we did today. Your message here. Everything we did today, the finishing up the handout and then the two problems out of the book that we just did. I load those in and those are due by the 24th, right? I think it's 24th.
yes, okay.
Yeah, so a week from Friday.
So we have to do it on the Excel sheet. That's the way you want them.
You can do it however you do it's fine. If you did it on paper, that's fine.
Okay, all
You
right.
take pictures of it, yeah.
Okay, cool. Thank you.
Yeah, welcome.
Good night.
Yeah, okay, good night, and I will see you.
Thank you.
And next week we'll have a practice exam, do some multiple choice questions and stuff and wrap up chapter 3. Okay, good night.
Thank you so much.
Have a good
Thanks,
night.
Professor. Have a good night.
Bye, guys.